Okay, welcome back to today's lesson. Today we are going to look at introduction to financial accounting, and so that is our focus for today. We are looking at financial accounting. Financial accounting. Now, financial accounting is two words put together: financial and accounting. And first of all, let us focus on accounting, because financial is an adjective that is qualifying accounting. Accounting comes from the word account, and to account means to give a record of an event or a report on something. That is account. And then financial comes from finance, which is basically monetary, things that are monetary. So financial accounting, from a literal point of view, is really about giving reports on financial events. That is what financial accounting is all about. My definition of financial accounting may be quite different from what is reported in some other books and by some other authors. I define financial accounting as the recording of business transactions and summarizing them into financial statements for decision making by the users of those financial statements. So I would say that financial accounting is the act of recording business transactions and summarizing them Alright, so this is my definition of financial accounting. It's the act of recording business transactions and summarizing them into financial statements for decision making by the users. Now, I'm sure you may have come across some other definitions of financial accounting where you see activities or actions like recording, you see classifying, interpreting, communicating, and a whole lot of functions that are performed in accounting. Of course, yes, all these functions have been performed in accounting, but I say that the two main activities that are involved in accounting or done in accounting is recording and summarizing. Of course, recording and summarizing is the two main activities that are performed in accounting. Why do I say so? Now, what we do is that we record business transactions. I want to take time to really explain this definition for you very well. Now, I said that it is the act of recording business transactions. So the first thing I want you to understand is that in accounting, we record something. And what do we record? We record business transactions. Business transactions or transactions. And what is a transaction or what is a business transaction? We will come to that. Now, we record business transactions, and at the end of the period, we have to summarize them into financial statements so that the users of these financial statements can base on them to make their own informed decisions. And that is what financial accounting is all about. Now, I know that you may have come across classifying and all those other activities, which are yes, correct, because what we do is that in recording, you classify. You cannot record without classifying, okay? So all those things such as identifying, measuring, and recording and classifying, all those activities are done whilst recording. That is why I said that recording is the key activity. And then also summarizing. Summarizing is that after you have financial statements, after you have your transactions, at the end of the period, you have to summarize them into financial statements so that the users can make informed decisions. Okay, so that is basically. So what I want us to look at now is that we are going to look at the key terms in the definition that I have put on the board. And then we are going to take them one by one and then break them down for understanding. So the key words here in this definition are: one, we have recording. And then we have summarizing. Then we have business transactions. And then we have financial statements. we have decision making. And then finally we have the users of the financial statement. So these are the basic terms in the definition. I said that financial accounting is the act of recording of business transactions and then summarizing them into financial statements for decision making by the users. Now, what is recording? Recording is the act of writing down business transactions into the books of accounts. So we write down the transactions into the book of accounts. And then summarizing, I'll come back to summarizing. I want us to look at a business transaction. What is a business transaction? Because we are saying that we record business transactions. So what is the meaning of a transaction? Now, let me give you a very practical example. Now, a transaction is any activity of a business which can be measured in terms of money or can be quantified in monetary terms. So any event that happens in the organization or the business which can be measured or which is monetary is a transaction. So let me give an example that, for example, if you are an accountant in a business, what you record are transactions and transactions alone. You cannot record things that are not transactions. And we have said that transactions can be measured in terms of money. So take, for example, that a manager slapping a secretary in the organization. This is an activity. But I ask you a question that as an accountant, are you going to record this that the manager slapped the secretary? Of course not. Because that is not part of your jurisdiction as an accountant. Why are you not going to record it? Because there is no monetary value attached to the slap. This one is more like a human resource issue. Now, if after the slap there is an injury and the business cash is taken and used to take the secretary to the hospital for medication, then the accountant will record because now money is involved. So what we are trying to say is that if anything happens in the business and it is not monetary, you don't record it as an accountant. That is why we are saying that financial accounting is the act of recording business transactions. So we record only events that are quantified in terms of money, and those are transactions. So with a business transaction, we have two types of transactions. Now, we have the cash transaction and we have the credit transaction. So when we look at business transactions, we have the cash transaction and we have a credit transaction. So these are two types of transactions that we have. We have the cash transaction and the credit transaction. Now, a cash transaction is any transaction which requires payment on the spot. So you buy, you pay instantly. So the payment can be by either cash, physical cash, or by check. Whether it is by cash or check, once it's payment or payment is made on the spot, we call it a cash transaction. Now the other is a credit transaction. A credit transaction is a transaction which defers payment to a later date. And so you buy today and then you pay later. Okay, so those are the two different categories of transactions that you may have. And so when we record them at the end of the period, then we do what we call summarizing. This is the meaning of summarizing. Now, we know that when we are recording accounts, we don't just record them. That is why we say we do classifying. We have a ledger and we have books for almost every transaction that are similar in nature. So we have a book for sales, a book for purchases, and all that. So what we do is that when we are recording, when we have transaction on sales, we record in the sales book, and that means that we are classifying them, we are putting them into classes. When we have transactions that are related to purchases, it will be recorded in the purchases book. Now at the end of the day, what we do is that at the end of the period, we need to find our profits or loss, because we said that the key objective of every business is to determine profitability. So what we do is that we have to do what we call a summary, because from January to December, at the end of the 12-month period, which is usually the period where we prepare financial statements, what we do is that we need to know the profit for the whole period. And by that time, we may have recorded in several books. We may have over 50 books that are full. We cannot go back and pick those books and begin to calculate one by one. What we do is that we have to do what we call a summary. So if there are 20 purchases books, we can add up every page of the purchases book and get a total for each page. Add up all and get a total for each book. add up the books and get a total for the 20 books or so. And we can say that this is the total value of purchases for the whole period. When it comes to sales, we do the same. And that act is what we call summarizing. And so we we record transactions, and then we balance up our account, we extract a trial balance. Now at the end of the trial balance, that is when the recording ends. We pick the trial balance and then we summarize it into financial statements. That is where we have our income statements and the statement of financial position. That is the aspect of summarizing, whereby the recorded transactions will be reorganized into financial statements. So summarizing is the reorganization of the recorded transactions into financial statements so that it will be understandable, and that is where we communicate to the users for decision making. And so we summarize into financial statements. Now, what are financial statements? Financial statements are statements that are prepared at the end of accounting period to show profitability, liquidity, and then the cash flow position of every business. So these are the three key reasons why we prepare financial statements: profitability, the liquidity issues, and the financial position, and then we also look at the cash flow position. So financial statements will be prepared. Of course, that will be a major focus of our series. So when we get there, we will talk extensively on that. And then decision making. Decision making is simply choosing from among alternatives. When you have a lot of alternatives and you make a choice, that is a decision you have made. And decisions are made by the users of the financial statements. And so we need to know who these users are, and then what kind of decisions do they make with our financial statements. Okay, so we look at the users as well. Users of what? Users of financial statements. So I want to look at it at users of accounting information. The users of accounting information. Now, who are they? The users of accounting information are the various groups of people who use or who needs accounting information to make various decisions. Okay, so they depend on the financial information that is produced by the accountant to make various decisions. Now, of course, some of them are direct users, some are indirect. Okay, but our focus right now is not on the direct and indirect, but we are looking at the internal and the external users as well. Of course, some are internal users and some are external users. As far as I'm concerned, I want to present to you only two internal users, which are the managers or management and the employees. These are the two internal users of financial statements. Now, there are a lot of external users, like the shareholders or the owners of the company, government agencies, and all that. Now, we are going to look at the users. We are going to look at each of the users of financial statements, and then we look at why they need financial statements. We look at the purpose or the type of decisions that they make whenever they get access to financial information. So I want to begin with the shareholders of a company. That is, and in the case of partnership, it will be partners, or let me simply say the owners of a business. Why do they need financial statements? Now, whenever you are writing an exam and you are asked this question that explain the users of financial statements or users of accounting information, what the examiner expects from you is to, one, mention the user of financial statements, and then two, define the user, explain who the user is, and then three, you state why they need financial statements, the purpose. And so there are three things that are expected from each point you raise. That who is the user of financial statements, and then you mention the name, and then you explain who they are, and then you tell why they need accounting information. So we begin with our shareholders or our owners. Who are they? In some books you see them as investors, which is also right. So who are they? Investors or shareholders or owners. Now, these are the people who contribute money in a form of capital, and they invest it into the business so that the business will operate. So they are the owners of the business. They put their money into the business so that they naturally expect something. And what do you think they expect? They expect profitability, because of course everybody who is an investor expects a return from the investment. And so these people invest their money into the business, and they expect their financial statements to be profitable. And so what we do is that you explain that These are the people who have invested their money into the business, and they need accounting information to ensure profitability, to be sure whether the business is making profit or not. And what are the decisions they will make? They make a decision whether to continue to invest into the business or to stop investing based on profitability issues. So they are concerned with profitability, and they need accounting information to be sure whether you are making profits. That will encourage them to continue to be investors or otherwise. So that is the first user. Now, we can also look at the managers of the company or the business, the managers or what we call management. Of course, the shareholders are external users. The management is in an internal user. Now, what do you think management will need accounting information for? First of all, we have to explain who they are. Who are they? The managers are the people who plan and control the activities of the business. They are the people who oversee the business. They are stewards. And let me tell you that financial accounting even came into force because of stewardship. If you look at the history of accounting, it is because of stewardship that accounting even had to come into force. It was born out of stewardship because I have the resources. I want to set up a business, but I don't have the time to operate the business. So what I will do is that I will invest into the business and appoint somebody to oversee the business on my behalf. I may go to do whatever I want to do elsewhere, but when I return, I would expect that the steward reports back to me on the financial activities of the business. That is how accounting came into being. So managers will need financial statements. Okay, first of all, they are the people who plan and control, and they need financial statements to help them in their planning and control of the business. So they also look at profitability issues. They also look at liquidity issues. They look at almost everything that will help them to plan. They want to know their performance as managers. Are they doing well or not? And are they meeting the expectations of shareholders? Of course, the expectation of shareholders is to maximize their wealth. And that is exactly what the management will also be concerned about. And that is the main reason why they also need financial statements. Recently, they have been issues of agency problems, but that is not our focus for now. We will look at that in the subsequent topics ahead. But definitely managers want to know profitability to plan and control the activities of the business. And then also we can look at our suppliers. Our suppliers as a user of the financial statement. Now, suppliers, who are suppliers? Now, suppliers are the people who give us, or they supply to us raw material. In the case of a manufacturing business, sometimes if it is a trading business, they give us, they supply us with the goods that we sell, and then we sell. Most of the time, these suppliers give to us on credit. Okay, most of them they give to us on credit. And so what we do is that we take it on credit, and then we expect to pay them back later. And so because we owe them, we have to pay. And therefore, they will also need our financial statements to be sure whether we can be able to pay. Are we credit worthy, so that they will continue to supply to us on credit? They want to be sure that we can pay our debts as and when they fall due. And it's very, very important that suppliers will need our financial statements to ensure that we'll be able to pay our debts as and when they fall due. All right. Then we can also think of our customers. Our customers. Our customers are those who patronize our goods and services. People who buy from us. Okay, they are the lifeline. They are the people we sell to on credit most of the time. Sometimes they buy by cash, but whichever means that it is, we supply them with whatever resources that we have at our disposal. We sell to them our goods and services. Now, they will also need financial statements, because for all you know, we may also be a very big supplier to them, and that they will need the financial statements to be sure whether we will continue to be in business. They want to ensure the going concern of our company or our business, so that they will continue to deal with us. Sometimes they owe us, and when they owe us, they will still need our financial statements, do their own analysis to know when we will also be coming for our debt from them. So a lot of reasons why our customers or our debtors will also need our financial statements. Very, very important. Now, the government and its agencies can also use our financial statements. Government agencies. Now, in every company, in every country, there are laws. A government has agencies that regulate businesses. Now, one of the key government agencies that will need our financial statements are the tax authorities. In Ghana is the Ghana Revenue Authority, and then the statistical services as well may also need our financial statements for statistical purposes. Now, they are the people that the government has put in place to regulate with the businesses, and then they need the financial statements of the business so that they will also assess our tax, for example, and know whether we are paying the right amount of tax, whether we are abiding by the laws and regulations as far as the tax laws are concerned. And then the statistical services in Ghana may also need a financial statement for statistical purposes. So these are a few uses of financial statements that you can look at.